We're going to talk about the dark pool and how to look at dark pool data and draw conclusions from that data. So I'm going to go into the white paper of squeezemetrics so that it's going to go into great detail about how you can actually kind of read into dark pool information. But primarily what I do is just draw assumptions from charts. To draw a conclusion from this chart, there's two basic principles you have to understand about charts. Charts make sense only when the underlying thing that they are studying or measuring is correlated. So, in this example, the blue line is the DIX. This is a proprietary indicator from squeezemetrics. And the green line is the S&P 500. So you can safely assume that these two are correlated because the blue line directly has to do with off-exchange traded equities, and the S&P 500 is the most heavily traded equity ETF product of all. And so you would imagine those are probably fairly highly correlated. This is just common sense. This is just using your brain to critically think. Then we can add over top the GEX, which is gamma exposure. So we can definitely assume that gamma exposure is very highly correlated with these other two indicators. So all I'm going to do is I'm going to show you what I look at. It's a simple common sense experiment. I didn't read the white paper until I made this video, but you can successfully trade just simply watching these charts and kind of if you layer on top the other understanding of the market that I want to show you over time. But so the very first thing that you're going to notice is that the blue, it's at a high when the green is at a low. Right? That's very simple. So the highest peaks are after drops in the green line, which is the S&P 500. You can trade on that, just that alone. When this peak's incredibly high, you buy. It's very simple. And it's almost always primarily at an extreme low. So this is September 15th. The 1st of September 15th. The market's at 1913. You bought right there. And all you had to do was hold that. And, if you wanted to, you could sell that when you get a low signal on the January of the 2018, end of January 2018. The market was up 1,000 points. If you buy when this signal is high and sell when the signal is low, you're trading with the smart money. This blue line, it represents what smart money is doing off exchanges. It's very simple. So, you could argue that we haven't had the sell signal yet. You could argue that we haven't had the sell signal yet. The blue line, it's not going down. So if you wanted to, all you have to do, wait for this blue line to hit a record low. Wait for it to match up 2018, the 2018 peak. Well, that's a very fair argument. So, according to the SEC, trades marked with the seller short comprise about 49% of equity share volume. In other words, about half of all selling volume in the market is short selling. So unless we actually believe that half of the market volume is speculative short selling, this demands an explanation. It's a very simple explanation. When you buy something in the market, that market maker has to sell that to you. The market maker does not own anything, so they are short selling. That's a short sale. The market maker is the reason why this volume is so high, because most of the volume in the market is buying, and so that they must then short sale those things, whatever you're buying, to you. And an interesting note is this is why market makers are exempt from short selling restrictions, and it's this little tidbit that is actually responsible for like the leeway that naked shorting can still be possible, even though it shouldn't be. They can play around because there are, there's no restriction, and there's not really much oversight as far as market makers go on what they can short sell. So short volume is actually representative of investor buying volume. So FINRA has collected short sale volume data from their trade reporting facilities. The TRFs receive data from exclusively off-exchange or dark venues. Some of these venues are alternative trading systems or dark pools, as some are internalizers. Since our analysis doesn't need to distinguish between types of off-exchange venues, we'll refer to all data from the TRFs as dark pool data. So dark pools, we can get technical, and they're not all dark pools, but in essence, we're just calling all off-exchange venues dark pools. Okay. And it gets very, specific, and it explains dark pools, explains the market maker and how it works. Read the white paper yourself if you really want to get technically, a technical understanding about what's going on, and they go through the data. It's very useful if you really want to understand this stuff. Okay, so very high relative percentages of dollar-weighted short volume are associated with mean 60 market day returns of 5.3% as compared to a mean of 2.8% across the whole data set. Since the DIX, the DarkPool Indicator, tends to rise into corrections, which is what I showed you, we are left to believe that reflects a broad willingness of investors to accumulate S&P 500 components at lowered valuations, and that high levels of short volume correspond to positive medium to long-term investor outlooks. This has been reflected in the data, as I showed you. We get a scatter plot, and the data is only 10 years old, so the fundamental nature of this tool, it can change, it can shift. This might be useful now, but then let's say new regulations are enacted, dark pool regulations are enacted. That might change the nature of this tool. Okay, and just to make it clear, I'm not a shill for this. I have bought they have like a 72-hour pass. I did that once. It was totally useless for an individual stock. Maybe it would be useful for GME and AMC, since those are like heavily dark pool manipulated. Do not believe that they are retail traded. They are not. They are dark pool manipulated. Retail is not behind GameStop or AMC. Please believe me. There's no evidence of that, other than what the media wants you to see and what CNBC wants you to believe, because they're a Citadel-run media source, essentially. So, getting back to this, so now we can understand. Look at the blue number. The blue number at this peak is 50%. So that is 50% short volume. That's extremely high short volume. And so that short volume, what they're saying, it is a product of a lot of buying. Okay? Now, there is another hypothesis that they don't talk about. This is just kind of common sense, me chiming in. perhaps that short volume is so high because we're at a bottom and you have a lot of speculators at a bottom who are chasing. There's a lot of misconception that the smartest money is smart money, and they aren't. Time and time again, speculators are dumb money, and the hedge funds and other institutions are dumb money. And so you may see an uptick in short volume here because you have a higher degree of dumb fuckery going on, if that makes sense. And so this could just indicate, okay, it's kind of like a counter indicator. It's like, well, everyone's short, so let me get long. It's that type of situation. That might be what's in there, but in general, their belief is that this shows that there's a lot of institutional buying, and if institutions are buying, they're smart money, so they should be buying first before you. That's kind of the deal. You can interpret it different ways. That's the primary thesis that we're going to work on. We're going to assume smart money is big money. So, I've already shown you the basics, how when this is high, you buy. When this is low, you sell. We were very high for a sustained period, the highest levels we've ever seen right here. And for the longest sustained period of time right here. But I do want to show you something that's a little worrying that you should be worried about. We went low. We went low immediately. So usually after a sustained correction, you'll see this like drip down, drip down, drip down, drip down, drip down, and then we go low. And that's kind of been how the markets work, because usually how we correct, it becomes you correct and then you go into a sustained period of upward movement. Well, and that low was actually lower than in the drop in 2015 before the August drop. In 2015, we actually went lower than that, suggesting that that would have been a good time to sell. And if you can see in the green, that was a great time to sell, by the way. It was a great time to sell. And after that sale, where does the blue go? We never really, comparatively, we got back to this level that is equatable to after the 18 crash, after the January crash in about April, we see a big DarkPool spike up, indicating buying activity. We get a similar level here at 3,700. And so that was a very kind of like a brief run after that. And as you can see, after that, we went back and we reverted. We reverted back to the same level that we saw before another crash in September 18. Right? So we've been getting a lot of these sell signals while the market, but here's the thing though, the market, when we get these sell signals, we get little brief dips. We don't get the major correction, right? We're getting brief dips. So this is a very, very unique time. This is an incredibly unique time. Like in the case of the DarkPool, we have 10 years of data. This data is not in line with former data. Usually this would resolve itself in a pretty substantial correction. We're not getting that, but then we're also not getting sustained buying pressure. We're at like a normal level. We're back at like just a normal level. It's not telling you that there's strength. It's not telling you should buy. And that should scare the fuck out of you. That should scare the fuck out of anybody holding stocks, because this is just an unknown period of time where valuations are at incredible highs, but we don't see the DarkPool activity to corroborate those highs. So and then we're seeing these like multiple low spikes similar to July of 14. And that was all kind of before a pretty significant correction back in the olden days, when a significant correction was like, where did it go, 2000 to like 1900, so like 100-point drop in a day, in a couple days. Yeah, like a 200-point drop. Yeah, that was like a 300-point drop. So a 300-point drop back in the day. And we're seeing kind of sustained selling pressure that's sort of like that. So, yeah. And then I want you also to notice that you have this like very thick banding. Look at the thick banding before the 2015 drop. Look at the, let's find some of the thick banding. Like the thick banding, generally it tells you directionally where we're going. So if you have thick banding on top, like let's say we have a high level of thick banding, we're going up. Notice we didn't have the banding isn't as thick as it was back in the other times. It's very sporadic. It's not as thick. It is thick, and we definitely see the result of that. But that's something interesting to pay attention to, because we have the thick banding now. And it's kind of low actually. So in theory, if I'm right about there being a mega correction coming, you would think that you wouldn't see extreme selling, because you would expect that there's a lot of deleveraging that has to happen here. A lot of the smart money needs to get on sides of a good position, and they will not unload. You may have heard Wyckoff distribution recently. It's become such a trendy fucking thing. Wyckoff is a sort of a end of cycle pattern. It's a specific kind of way that it shows distribution. It shows prolonged selling, because you don't want to just unleash a massive position. You want to sell it gradually into strength as much as possible, so you can get the best price for whatever you're trying to sell. And so that would be my theory as to what we are seeing here and what's being represented with this banding at a fairly low level. I mean, if you look at this level, it's the same level. If you look at the median of this level is the same level we had all of last year. Right? All of last year. So I would strongly urge you, get the fuck out of the market, be cash at least, and then pay attention. Just pay attention. If we get a very high reading here, just get back in the market. You know smart money's ahead of you. But in my opinion, you're not going to see that. In my opinion, we're going to get a massive spike down that's going to wreck. It's going to be unimaginable. Like, what we're about to see is unimaginable. And I also want to show you something very interesting. We see 2018 was a manufactured sell. Lots of people in the know, they sold and they got the fuck out. That's a manufactured sell, and it's into a peak on the market. Check out we'll go to the last June. Check out the crash here. I'm going to make an argument based on this data. Nobody expected the COVID crash. Nobody expected the COVID crash. We had the first dip down. That's smart money's coming in and buying. That's unusual. They didn't expect this crash. That's my argument. They didn't start buying. They waited for the Fed to come out and tell them, it's okay. And then they came back in and they bought. And if you notice, this buying was not super strong. You see this band is not super consistent. And they were chasing. The biggest spikes were right here at 3,100. And then we go into an immediate dump off period at 3,500. It's like, okay, we got back to our old highs, and now we're out. We're selling. We're not buying here. We're selling. Okay. Oh wait. Oh shit. Now we got to chase. And so now you had a little chasing. That's what drove up the market right there. And then it immediately goes, they're selling. There's a little bit of buying right here. And now we have selling. So, it's a guess as to where you think the market's going to go, to be honest with you. Like, my prediction is down. My prediction is we see some more of these we see more dark pool selling right here. But I mean, it's a guess. We're at a peak, so why the fuck would we see more buying? We have massive inflationary pressures along with a bunch of deflationary pressures. I mean, we have stagflationary kind of environment right now. It would make zero sense to see it go up, but who the fuck am I? But so the really, really interesting dynamic here that really adds on to all of this is the GEX, which is just simply gamma exposure. When gamma exposure is positive, we have positive gamma exposure, so lots of call options being bought. When we have negative gamma exposure, we have lots of put options being bought, negative gamma being bought. And what you're going to notice, interestingly, is that gamma exposure is very indicative of tops and bottoms, and not in the way that you would expect. You see the highest gamma exposure at peaks, and you see the lowest gamma exposure at bottoms. So what would you expect? Test time. What do you expect to see at peaks? You expect to see the DIX low, gamma exposure high. That allows dark pool money. What does that allow? That means dark pool money is buying the cheapest counter options, right? So if the price is high, they're buying cheap puts. If the price is low, they're buying cheap calls. It's a fun game to play when you don't know what you're doing, but somebody else does. So that's what we see. We see gamma exposure high, the dark pool indicator low, indicating dark pool selling. It's a peak. And so we can use this principle to analyze the market right now. And that's what we're going to do. So, again, it's a little tricky now because remember how unique this time is. Let's look at the max time frame. You see that peak, the peak in the dark pool indicator is separated from the GEX, indicating, hey, we're going to go up from here. Let's see if I can find a good example. Oh, right here. Well, right here's a great example of 2018 because it was manufactured. I mean, everyone knew what was coming. Everyone was prepared. Gamma exposure's high, and the DIX is sustained. Has a sustained low. So that the alligator jaws really tell you a lot. Similarly, right here, that's after the flash crash at the end of 2018, which, by the way, not a lot of dark pool activity knew that was going to happen. Surprisingly, it's amazing. They're not really that smart. They really aren't. I mean, you see some, and that level is higher. The level before that crash is higher than where we are now. So keep in mind, when you're looking at this blue being up here in the middle, it might say, okay, well, we're not selling off here. Oh, no, sweetheart. That just means that they are sneakily doing something. They know people are watching them. Understand that. But we do see a sustained dip right here before it. And then we see a separation at the bottom of the dark pool indicator and the gamma exposure. And that's your signal. Buy the fuck out of that shit. I mean, that was a great run, right? That was a great run. And all you had to do is watch this. Incredibly useful. So then let's just kind of study. This is an anomaly, remember? This is kind of an anomaly where, so we get a relatively high dark pool separation from the gamma exposure. But what do we see from there? We do see more upward movement. But that upward movement was into the pandemic. So, and then you'll see that the dark pool indicator actually tracks the gamma exposure. So, so when it tracks gamma exposure, when both of them move in the same direction, that indicates the direction the market is moving. So that was down, so we knew that because that moved down here, so that moved down here, right here, that's an indicator right there. That's all you needed to know. And this is where I started to get short, and I got short. I wasn't actually watching this when I got short, but I mean, this would have been useful to see. Like, this went low together. We're gonna go lower, and we did. And then at bottom, yeah, we see gamma exposure staying low. And just keep in mind that this gamma exposure, it started peaking in 2019. At the end of 2019, it started going higher than it had ever been before. How interesting is that? Like, we see massive upward gamma movement right there. And remember, high gamma is indicative of a top. Low gamma is indicative of a bottom. And we saw massive low gamma up on the first wave down at 2,900. Like, so what this was going to develop into, if nobody came in to step this in, a lot of people got short with me. And that would have led into a reverse gamma squeeze, a gamma squeeze down. Because everyone was going to get short. Everyone was going to end up, their contracts were going to be in the money. They were going to be exercising the money. It would have been a negative gamma, what's it called? Gamma, what the fuck? Gamma bubble or whatever. What the fuck? So yeah, so this would have led into a massive negative gamma squeeze, but the Fed comes in, saves the day, we get this separation. But very interestingly, what do we get? We get a top, right? High gamma is indicative of a top. It's indicative of a top. It's indicative of a top. It's indicative of a top. We keep getting these higher and higher gamma exposures that usually in the past, in the history of this tool, has been an indicator for a reversal. But instead, we're actually seeing this play out as the gamma squeeze. And I'm going to argue it is a reversal. The gamma squeeze precludes the reversal. That's all we're seeing is a blow-off top in action. We only have data from the past 10 years. We can't analyze oil in 2007 was a blow-off top. And I have a feeling it would look a lot like this. I have a strange fucking feeling it would look a lot like this. So let's go in and let's analyze. Specifically, let's look for separations. Gamma exposure high, dark pool indicator low. What happens? The market goes down. The dark pool indicator leads. Gamma exposure being high is like an extra juicy indicator. It's like an indicator where the people in the know what's about to happen. But then, where is it? We get a period. So, for instance, okay, so right here we get somewhat fairly high gamma or high dark pool indicator, low gamma exposure. But we also get these bouts of consistent high gamma exposure and high dark pool indicator. So this period right here, I mean, this should have told you all you needed to know. You're buying. You need to be buying right now. So, then we get a period of low dark pool indicator, high gamma exposure, relatively, followed by high gamma exposure and relatively high dark pool indicator. Then we get high dark pool indicator, low gamma exposure. So this was the indicator right here where you could have gone long off of this. But it was a kind of a mixed signal because we also had low gamma exposure and low dark pool indicator. But it wasn't super strong. So we're getting very mixed messaging, in my opinion. Very mixed messaging. And that's a great sign that this is a top. In my opinion, I'm biased. I'm fucking very short. Because right after that, what do we get? The most huge, massive gamma exposure the market has ever seen at the top at 41.27. And where's dark pool indicator? Bye-bye stock market. Whereas this is kind of predicting a squeeze higher, this is not. This is saying we're stalled here and we're not moving. And ever since then, we haven't gotten an indicator that is supportive of a move higher. We've gotten this is a move supporting a move lower. It precluded that drop. Actually, it went in conjunction with that drop. We see separation of the dark pool indicator here and the gamma exposure, but it's nothing substantially. We can't trade on it, in my opinion. We can't trade on any of this. Basically, gamma exposure and dark pool indicators tracking until recently, until right here. This is the first time I'm starting to get the vibe that we're separating again negatively. Gamma exposure is increasing. So if I had to predict it, I'm going to predict that next week is going to be up just a little bit starting the week. And I'm going to look for confirmation that the dark pool indicator is going to drop. And what I'm looking for is this dark pool indicator to go back down here to a negative, and I'm looking for the gamma exposure to go upwards. That's what I would like to see, but very possibly we could see the gamma exposure start to track the dark pool indicator back down. So that's what I'm hoping to see. Again, I don't know if I said this already. I'm not a shill for this site. This tool right here is free. Squeezemetrics.com. You read the white paper. You can do this. You can buy one of their plans if you want. Like I said, it's kind of useless in my opinion. You have to decide, if you want to experience it. 72-hour pass. Check out the tickers. Check out GME, AMC. See if you see these trends that I'm talking about. I don't know, honestly. I haven't looked at them. I don't think it's worth it. I'm not paying for it. But it might be if you're a more active trader than me. I really don't actively trade too much, so this is a free tool, and as a free tool, this is the most useful tool on the internet, in my opinion, to trade stocks. I mean, I could trade stocks effectively year-round with this, just on this information alone. I mean, it's so fucking easy. It's really fucking easy. Taking this in context with everything else that I kind of understand about the market, it's real easy. Man, I don't know how long this video lasted. I rambled on. My first video, I don't know how it's going to turn out. So we'll see. But I hope that this helped some of you to kind of give you a new tool to utilize when you're looking at the market. So if you watched this whole thing, I love you a lot. Kisses, hugs, all that other stuff. Peace out.